Evaluate a company's management of accounts receivable, inventory, and accounts payable over time and compared to peer companies. So we have three areas of a company's operational business to discuss here: accounts receivable, inventory management, and accounts payable. Now, when we assess each of these areas, the turnover ratio and number of days outstanding will be vital metrics for us. Although we have some other ideas in each area, the turnover and days outstanding figures will be key to all three. In each case, you can compare this company's figure to their historical values or to their peers to assess how a firm is performing in terms of receivables management, inventory management, and payables management. For example, when we are thinking about the company's ability to collect on credit sales, longer is obviously worse. We want the number of days that receivables are outstanding to be as low as possible. In terms of inventory management, a rising inventory turnover, which would mean a falling number of days of inventory, would indicate that the firm is seeing that inventory levels as they currently stand may not be sufficient to cope. There has been some change which is causing inventory to move from ready for sale to sold quicker than it was before. And then when we look at accounts payable, we're thinking about the length of time it takes for us to send cash to those we have bought goods from on credit. If we are paying them too soon or sooner than is necessary, we're losing out on interest we could be earning on the balance. If we take too long, we may earn a reputation and lose potentially favourable terms with these credit suppliers. Just as a reference, here are all of these formulas again. We had these earlier in the reading, but it's no harm to refresh here. Receivables turnover is credit sales over the average balance in the receivables account over the period, and days receivables is 365 divided by this receivables turnover figure. Inventory turnover, you will remember, is simply calculated by dividing the cost of goods sold by the average level of inventory, and the number of days of inventory is calculated by dividing 365 by this inventory turnover amount. Finally, then, payables turnover is calculated by dividing our credit purchases by the average balance in our trade payables account. The number of days that payables are allowed to remain outstanding is given by 365 divided by this payables turnover figure. Okay, so what else have we got? Let's start with accounts receivable. There are four major tools used in the analysis of accounts receivable. As we have discussed already, we have the receivables turnover and the number of days that receivables are outstanding. Apart from that, we might consider building an aging schedule, and we could calculate the weighted average collection period. Okay, the aging schedule. This is a table of how much money we are owed in receivables, organized by the length of time they have been outstanding. In this very simplistic example for one period in the company's history, this company has $100 of receivables we call current, which is less than 1 month old. Another $100 which is past due, between 1 and 2 months old, and they have $200 worth of receivables outstanding for more than 2 months. Now, if we look at these receivables amounts changing over time, for example, in the most recent 3 quarters of business, we get a picture of how receivables are being managed. For example, in this case, it's clear that in the last 2 quarters we have collected a significant portion of our short-term receivables, but there has been $200 outstanding for greater than 60 days going back to Q2, which might indicate that the very same $200 has been outstanding for the better part of a year. That would warrant some investigation. So far, we have shown this table in terms of actual dollar amounts of receivables, in terms of the length of time outstanding and how those numbers have changed over time. But it is also possible, and sometimes helpful, to build an aging schedule based on the relative amounts of receivables in each category, by dividing the amount in each box by the total receivables figure for that period, and seeing where the largest portion of our receivables lies and how that balance is changing over time. The weighted average collection period then. To calculate this number, we look at the amounts due in the current period in terms of their relative size. In this case, for example, we have a total of $400 in receivables, 50% of which has been outstanding for more than 60 days. From there, we record the average number of days that receivables are outstanding in each category. I'm going to use some arbitrary numbers here to illustrate this idea. The last step then is to just multiply column A by column B, the average number of days outstanding in each category, by the proportion of the overall receivables in each category, and then take an average. That average is the weighted average collection period, the weighted average estimate of the length of time it takes us to collect on a credit sale. Moving on then, let's look at inventory. There are two major risks with inventory management. When inventory is allowed to fall too low, we risk a stock out, which is when we cannot sell products because we don't have availability when a buyer is interested. On the other hand, when inventory is allowed to accumulate, we start to worry about carrying costs. What is it going to cost us to house and store an increasing amount of inventory? Now, when it comes to putting together an inventory management analysis, a company's efforts to maintain this balance between too low and too high is built on the inventory turnover ratio and the number of days of inventory. Following those, we might also consider the EOQ or OP, just in time, and manufacturing resource planning methods. EOQ or OP stands for Economic Order Quantity Reorder Point. With this method, the company will minimize their stock, ordering only when the inventory level reaches a certain reorder point based on factors like ordering costs, carrying costs, expected demand, and expected lead times. Overall, we're looking for the cost minimizing level of inventory. The company might implement a safety stock level or an anticipation stock level amount of inventory they perceive to be an appropriate cushion given an analysis of both continuous and seasonal demand. When inventory levels reach that safety level, the order is placed and inventory repeats its cycle. The amount that they order is called the economic order quantity, the amount that will satisfy use while maintaining the safety cushion. With the just-in-time method, the company will be looking at minimizing their in-process stock, raw materials, and stock not ready for sale. This is a system of analysis based on the entire production cycle, aiming to order stock based on historical levels of demand. With the manufacturing resource planning method, the scope of the analysis widens to include both the acquisition of materials and the production cycle. This system aims to add a schedule of materials acquisition to the production schedule, gaining a broader base of information and analysis to improve efficiency and reduce inventory costs. Finally then, on to accounts payable. Just like when a company puts themselves into potential financial difficulty when they don't manage their receivables well, companies who pay their payables before they are due sacrifice interest that they could earn and potentially will wind up needing to borrow funds if they have spent cash too early. To assess how well a company manages their accounts payable, we will use the payables turnover, the number of days payables, and the cost of trade credit. The cost of trade credit is a tool we can use to evaluate the benefit of a trade discount, a discount on the price offered by the supplier. For example, if the terms offered by the supplier are 2 and 10 net 30, this is telling you that there is a 2% discount if payment is made within 10 days, and the net balance should then be paid within 30 days. So in this example, the supplier is offering us a 2% discount if we pay within 10 days. So within this time frame, not only do we have free money, in that we do owe it to the supplier, but we don't owe any interest, and we can use it as we see fit for 10 days. But we are also going to receive a 2% discount on the purchase price. Now, if we don't pay within that 10-day time frame, our cost of funds skyrockets, and then it's going to fall to the date when the net balance is due. To assess the benefit of the discount, we compare this cost of trade credit to the purchasing company's cost of borrowed funds. If it's cheaper to borrow than the cost of missing out on the discount, then we should borrow and pay within the discount time frame. The cost of trade credit is calculated using this formula. Now, this version may look a little different from the books and from online, but that's the way I like to remember it. Put the -1 in front and you won't forget to do it in the exam. -1 plus 1 plus percentage discount over 1 minus a percentage discount to the power of 365 over the days past the discount. This percentage discount amount is the discount offered for paying the supplier within the certain time frame. And this days past discount figure is pretty self-explanatory. It's the number of days after the last day of the discount that we actually end up paying. If, for example, we choose to pay on the 20th day, we lose the 2% discount for the benefit of holding cash for an extra 10 days. Using the formula, that indicates a cost of trade credit of 109%.